The euro at a 20-year low, and you know what? There seems to be no support. The way is down.
Right now, we have the Fed tightening into an inverted yield curve, and the economy, for the most part, most indications that the economy is weakening, and earnings have been weakening.
I think it's a challenging environment for European currencies. At the same time, I think the Chinese yuan could probably grind weaker over the near term.
We're in the middle of a perfect storm.
Hello everyone, welcome back to my channel. As you all know, some time ago, the market started kind of doing this correction. We were all bullish, thinking Fed really front-loading these rate hikes, and that we're gonna start seeing cuts pretty soon in 2023. But then we started hearing Powell sounding more hawkish. Now, the main question is, are we in an economic storm right now? Given the US dollar status as the world's reserve currency, and the US being the world's largest economy, when the US Fed sneezes, the world catches a cold. In today's video, Raoul Pal discusses the currency crisis, and how Fed hawkish rates can ruin it even more. So stay tuned till the end as he explains what's happening with the world, US and market. And if you are new to the channel, be sure to subscribe for more videos on economy, market, and crypto.
I think we've had, if we include the dollar, commodities, and rates, and the rate of change of those, probably the largest, fastest tightening in history. And to me, my forward-looking indicators make it look like economic growth is about to be pushed off a cliff. You know, I've been using 1974 as a good guide, where growth went, where the ISM went from 56 to 30 in 4 months. And that's the kind of magnitude of what I've got in front of me. I don't think it'll be as fast, but I think it's fast, which is kind of what you're picking up. Is what you're saying is, just to interpret it for people, is what you're saying is the reason these other central banks are calling the Fed and Janet Yellen is because there ain't dollars around, because the Fed is sucking liquidity out of the market, and suddenly all of the global borrowers are like, where's our dollars? I've been looking at the European banks again, as ever. I mean, they're just a slow death, right? It's a slow death of the banking system. It just goes on and on and on. And they look awful. And as you say, Europe and Japan got themselves in a situation where they can never raise rates, really. You know, whether the ECB managed to get it to zero or not, you know, but they can't raise rates because the layer of debt's so high. So it's just impossible to raise rates. And it looks like, my view is, real rates, 5-year real rates, which are plus 50 basis points or something now, that's, if I do a log channel on my Bloomberg, it's like the top of the channel. It's like we can't get to more than here in positive rates without breaking, and we turn back down again. And the trend rate of real rates is like negative 1% because of the debt issues and demographic issues. And I think what you're picking up is that we've already hit that point where suddenly Jamie Dimon, who's like, you know, he's a pretty smart cookie and he knows how to run his balance sheet, is saying there's issues here. Well, not issues with JP Morgan per se, but issues with the structure of the market and whether they can lend into this market or not.
Raoul Pal states that this has been the fastest tightening in history, and Fed is literally sucking liquidity out of the market. You have 4 Fed officials that are saying yes, 75 basis points at the September meeting. JP Morgan analysts too say that 75 basis points is on tap next month. So that's just meaning, oh wow, rates are going to be higher for longer than we expected. And that makes the dollar stronger than other currencies. Now that's great. I mean, if you're a tourist deciding to go to Europe for the summer. But it's not so great for American companies. That makes their products much more expensive. So it's a real headwind to American companies that have a good portion of the revenue coming from overseas. Not just this, it's pure evil, especially if you're in an emerging market scenario. When the dollar goes up, all the other countries buying oil, gas, and food in dollars suffer the most. We are literally seeing euro sinking below parity for the second time this year. And all this is happening, especially due to the European energy crisis, and the US getting more hawkish in their policy tone. Other currencies, including China's yuan and Japan's yen, also fell, pointing more broadly to markets reacting to a hawkish Federal Reserve. If you found this video informative, be sure to hit the thumbs up. Let's get into the next clip.
What I'm starting to think through is how similar this could be to 84, 85, where the dollar gets out of control, everybody's scrambling for dollars, playing a game of musical chairs where the Fed keeps taking away a chair, and the dollar goes much higher. So, okay, fine, you have an emerging market crisis, But I'm worried it's also going to play into that polarization that's already going on, where China says, we don't want the dollar, enough's enough, because the dollar's not actually 87% of world trade, but 87% of world trade is denominated in dollars. So the dollar's China's problem now. And it's the same for India, it's the same for Brazil, it's the same for Russia. And if we're not careful, the dollar's demise could be caused by the strength of the dollar, which has always been my base case, that if we go up too much, people are going to have to walk away from the dollar.
The dollar is once again in the spotlight. While this has been good for the United States in the past, there's a real risk of a currency crisis. This could have serious implications for the U.S. economy and the world economy as a whole. It could lead to a scramble for other currencies and a flight from the dollar. A currency crisis would have serious implications for the U.S. economy. In Raoul Pal's words, if we go up too much, people have to walk away from the dollar.
So there's a theory going around that I have some sympathy for, that after the Russian situation, the Federal Reserve and the US government essentially are going to use swap lines as a weapon. We will give you dollars, but in exchange, you need to do what we say. How are you thinking through that? Because they're creating a currency crisis here. It's kind of, if we're not careful and the dollar has another 10% higher spike, I mean, we're going to create a enormous global mess. We'll come onto the banking system in a bit, but just at country level, we've got some huge problems coming if we carry on like this. But politically, I think they're going to be a little more cautious. I mean, do they want to give swap lines to China? No.
No.
But they might go to a Southeast Asian country like Sri Lanka, let's say, who's got a real nightmare, and say, we can help you a bit, but we're going to expect you to toe the US line on global affairs and not the Chinese line. Because we've seen that kind of with Russia using reserves as warfare. I kind of feel like that might be around here.
Raoul Pal explains how he would see enormous global issues if the dollar has another 10% spike. He also talks about how the Fed and the US government move swiftly to calm dollar funding markets by extending swap lines to select central banks. According to Paul, all this is creating a currency crisis here. The dollar's strength will have a consequence for American companies as well as investors' returns. Strong shifts in exchange rates also have an obvious impact on the currently high inflation. So is the US dollar always the winner regardless of what happens? What's your outlook for the euro through the end of the year? Let us know in the comments. For more videos on economy, market, and crypto, be sure to subscribe, like, and share. I'll see you in my next video. Adios, and thanks for watching.